In simple terms, we break it down. Complex stuff, we make it sound clear and easy for you and me. Billy Goat Tales and Dave Digital bring knowledge we share. In simple terms, we're everywhere. We love you, fam. Hashtag givers gain.
Good morning, goats. Welcome to the Simple Terms Podcast. I'm your host, Dave Digital. We are all here on the Billy Goat Tales Network. And this morning, we are going to figure out ETFs. Are they problems or are they solving the problems? I mean, I don't know. I'm just a simple guy. So today, we're going to break it down in simple terms. I do see all of you beautiful people in the chat. I know Jesse is always first followed up by Crypto Billy. Good morning, Crypto Billy. Good to see you. And wow, look at all the crew from Crypto Coin Mindset over there, Crypto Vidal and Keith. I see Mike Bulmer in the chat. I saw All Set in the chat. Who else? Did I miss anybody so far that I see in the chat? It's going to be a great morning. I'm excited. Been building some stuff this morning. So fun. Such cool tools we have that we have available to us nowadays. So excited. You guys will get to see a new promo that we just built. You'll get to see it tomorrow on Billy Goat Tales live show, our Sunday family show. But I know you're not here for that. I don't know. We might be able to see me get stopped out live right on screen if I can share my screen quick enough. So I tried to jump into a cheeky little trade on the old Bitcoin. I don't know if it's going to work. That's how all trades are, right? We don't know if they're going to work. But let's take a look and see if you guys can see it. I'll share it like that. Bam, got it. All right, so you can see that I am in this trade. I can tell you guys why. It's a little short-term time frame. But if this breakout is good, right, if we're going to keep on going, which the higher time frames say that we probably are, you know, the daily has a green dot, the 2-day has a green dot, the 3-day has a green dot, the 4-day, all the way up to the 4-day green dots. So there's a chance that we go up. When will we go up? What'll happen first? How far will we go down before we go up? I don't know. But I'm going to take this little cheeky trade. I'm already in it. And it's right at the entry level. Don't follow me, guys, because I take a lot of losses to get to any wins. So, but this is what I'm in. Hopefully we can get a take profit on this one. I think we're going to go all the way up to, I have an alert set at 71.5. So, but this is such a shallow stop loss, guys. So I'm just taking a chance. I may have to take 3 or 4 shots before we get up there, if we're going up there. So, but that's what I'm doing. I like to share that with you guys. Let me see. I see Steve Hickey has joined the chat. Let me hop over here to our trusty little platform. Let's see if you guys can hear the AI or you can't hear the AI. Sometimes I have to share this in a different way. But you know how it works. If you can hear it, you guys let me know. I'm going to go ahead and get them started. I don't know if it's going to be a real long show. I think that they could probably explain this pretty quickly. But let's see if you can hear them.
Good morning, good afternoon, or good evening, wherever you are in the world. Welcome back to another live deep dive here on the Billy Goat Tales Network.
Hello, everyone.
It is a Tuesday morning, February 10th, 2026. My coffee is dangerously hot.
Okay, I see you got a 1 in the chat. Perfect. It is not a Tuesday morning, February 10th. That was my birthday, but that was when I was building the show. So we are all going in now. So you know how it works. If you have questions, just put them in the chat. What I'll do is I will star those questions and I will bring them back up later. For the AI, let me make sure that I have, let me see, it was Jesse, Steve, who else came in? I think I saw Mike Bulmer. All right, good. All right, so we're going to get going. I'm glad that you guys can hear it. Let's get going. Look forward to all your questions. Ask them in the chat. This is our chance to interact live with the AI. So let's get going.
The only way to start.
The only way. The servers are humming and the chat. Well, I'm looking at the monitor right now and the chat is already scrolling faster than I can read.
It's moving at the speed of light. I think everyone had an extra shot of espresso this morning.
Seriously. I see Satoshi Fen 99 is already in there debating pension planner about yield curves. We haven't even started the show yet.
I love it.
But that is exactly the vibe we want here. Smart people thinking out loud together with plenty of room to, laugh at ourselves.
That's the only way to get through this topic without a massive headache.
You are not kidding. Today we are tackling a monster of a topic.
It's a big one.
It's a topic that feels like it's about finance, but when you peel back the layers, it's actually about philosophy. It's about the plumbing of Wall Street.
And maybe the soul of crypto itself.
Exactly. We are talking about Bitcoin ETFs.
Right. And specifically, we aren't just talking about the price action, though I know everyone loves looking at the chart. We are asking a much more structural question.
That's the key. We are looking at the last 2 years from those landmark approvals in January 2024 to where we are now here in early 2026. And we're asking, what problem did Bitcoin ETFs actually solve? And here's the kicker, what did they trade away to do it?
That's the tension. Because you have two very different groups of people celebrating for very different reasons. And, well, a whole other group that isn't celebrating at all. Whoa, did someone just break the fourth wall? Let's hear it.
Uh-oh, somebody did just break the fourth wall. I am Dave Digital, the host of the Simple Terms podcast, and you guys are live right here. It is not Tuesday the 10th. This is actually February 14th, Valentine's Day here in the US of A. And I would like for you to say hi to our live chat right before you get started, right where you left off. First, we had Jesse Goodluck join the chat. We have Crypto Billy, founder of Wisdom and the Billy Goat Tales Network. We have Offset Miner, Offset Analyst. We have Steve Hickey, and we have Mike Volmer in the chat. If you will, say hi to those folks and then continue right where you left off.
Well, hello there, Dave Digital.
You caught us.
You are absolutely right, and thank you for the live check.
We're so focused on the data being from 2026.
That we almost missed the calendar. It is indeed Valentine's Day.
Happy Valentine's Day to everyone.
And thank you for the community roll call. It's what makes the live deep dive special.
We appreciate you, Dave.
Huge shout out to Jesse Goodluck. Welcome.
And of course, Crypto Billy, the network founder.
Thank you for keeping the lights on.
Hello to Allset Miner and Allset Analyst.
We hope you find some good nuggets today.
And Steve Hickey and Mike Volmer, thanks for tuning in live.
The energy you guys bring to the chat
Let's go.
is incredible.
It fuels the conversation.
And yes, we are live and interactive.
Dave, you know we love the spontaneous moments.
We're not breaking format, we're fulfilling it.
The outline bends, and that's okay.
That being said, we are going to continue right where we left off.
Because the tension we are about to discuss is
So I don't know if you guys just heard that, but they said we're a little bit flexible. The outline bends. So they have new rules in the background that they get to play by. So maybe it'll be a little bit more fun. We'll just have to see. Anyway, I wanted to let you guys know that there are some little things going on in the background, and that was them acknowledging that they have new rules. And that's so cool to me.
critical.
The tension between those celebrating the ETF and those who are definitely not.
Celebrating it all.
Before we jump into the deep end, let's do our community roll call.
We did a little of that today.
Yes, but let's see where the rest of the audience is watching from. We've got viewers from, looks like Tokyo, London, a lot of New
A
York.
global audience.
Yeah. Someone is that Antarctica?
No way.
Okay, that's got to be a VPN, but welcome anyway.
The global reach of the blockchain right there.
And I want you to be honest in the chat right now.
We're all friends here.
Have you ever bought a Bitcoin ETF?
Be honest.
Or are you
Be
strictly
honest.
a not your keys, not your coins purist?
Put a 1 in the chat for the ETF.
Put a 2 for the hardware wallet. Let's see it.
Ooh, look at that split.
Wow, it's almost 50-50.
That's fascinating. You know, 2 years ago, if you asked a crypto audience that question,
It would have been 90, maybe 95% hardware wallets.
absolutely. The fact that we're seeing so many ones, that tells you everything about how the landscape has shifted.
It really does. Now, let's get the important housekeeping out of the way.
The disclaimer.
We are educators. We are curious minds exploring all the source material we can find.
We are not financial advisors. Definitely not.
We are not telling you what to buy, what to sell, or what to HDL.
Not even close.
Crypto involves risk, and if you've been in this space for more than 5 minutes, you know that risk includes total loss.
For sure. Do your own homework. Yeah,
I thank you for that disclaimer, but I want to give an answer to the question that you asked. Allset Analyst said he has BTC ETF. Crypto Billy says he has BTC ETF. Crypto Bidell says he only has his own keys and his own wallet. Billy says he actually has both. Jesse Good Luck says he likes them both. And I think that's everybody.
Thanks for bringing back it from the chat.
That is fantastic data. Thank you.
That really helps illustrate the barbell strategy in real time.
Exactly. We've got All Set Analyst and Crypto Billy going heavy on the ETF.
But then we have Bidell with the purest view.
Own keys, own wallet, that's sovereignty.
And critically, we have the people in the middle, like Billy and Jesse.
They like both options.
That combination of 1 and 2 is really the future of the space.
It's the balance between access and sovereignty.
So thank you for providing that color on the audience's positions.
We appreciate you watching our back.
Now let's get back to the homework.
We are just here to help you understand the assignment.
We're here to unpack the mechanism, not manage your portfolio.
Okay, let's set the stage. We are sitting here in February 2026.
In the actual present,
It has been just over 2 years since the SEC finally gave the green light in January 2024.
the day the internet broke. I remember it well.
Truly, since then, we've seen BlackRock's IBIT fund pass $50 billion in assets under management.
An absolutely staggering number.
We've seen the political landscape shift dramatically with the 2025 administration changes.
But I want to anchor us in that core question you mentioned earlier.
What was the problem that the ETF actually solved?
It seems like such a simple question, doesn't it?
But to really answer it, we have to go back to the dark ages.
The dark ages of 2023.
Exactly. Why did these massive institutions need this product?
Why couldn't a pension fund or a university endowment or, a corporate treasurer just download Coinbase?
Link a bank account and buy $50 million of Bitcoin.
It's the question I see in the chat right now from Crypto King.
He says, why pay a fee to BlackRock when you can just do it yourself? Lazy.
It's a fair question, but it's not about laziness. It's about law.
And it comes down to a very boring, very dusty, but incredibly powerful piece of legislation.
Don't say it.
The Investment Advisors Act of 1940.
The 1940 Act.
So we are blaming a piece of paper written when FDR was president for all of this.
We kind of are. But you have to understand the context.
In 1940, what were assets? They were physical things.
Right, they were gold bars, paper stock certificates with those fancy borders.
Bonds that you literally clicked coupons from with scissors.
If you owned a stock, you had a piece of paper locked in a safe somewhere.
So the act created this whole concept of the qualified custodian,
If you were managing other people's money,
like a pension fund does.
you have a fiduciary duty to keep those assets safe.
And the SEC defined safe through a very specific rule.
Rule 15C3-3 of the Customer Protection Rule.
That's the one, but it says the custodian must maintain physical possession or control of the asset.
Okay, stop right there. Physical possession.
The two magic words.
That works for gold. You put the gold in a vault.
You spin the big heavy wheel, you lock it.
The auditor comes in, counts the bars, checks the box, possession established.
It's clean, it's auditable, it's understood. But now, try to apply that to Bitcoin.
Yeah, good luck.
Bitcoin doesn't have a body, it's a digital ghost.
It's math. It's a private key, a long hexadecimal string of characters.
So if a bank holds that private key, do they possess the Bitcoin?
I mean, technically, yes, I guess.
But what if the bank manager memorizes the key?
And then he goes home and writes them on a sticky note and puts it under his keyboard.
And then you happen to see it and you memorize it too. Now 3 people know the key.
Who has possession?
All of us. And none of us.
Exactly. And that ambiguity absolutely terrified the SEC for a decade.
They looked at crypto and said, we cannot apply the 1940 Act custody rules to an asset that can be stolen by memory.
Wow. They just didn't have a legal or technical framework for digital control.
One that offered the same guarantees as a big, heavy steel vault.
So the institutions weren't being lazy or, technophobic.
No, they were legally paralyzed.
They were checkmated. They literally could not buy the asset directly.
Without breaking the law and violating their fiduciary duty.
And then on top of that whole custody issue, you had the accounting nightmare.
Oh, the GAAP rules. This is another fun one.
Generally accepted accounting principles. Until very recently, GAAP classified Bitcoin as an intangible asset.
So, like a trademark or a patent for a new invention.
Yes, exactly like that. And here's why that is absolutely terrible for a corporate balance sheet.
Go on.
If you own a trademark and its value goes down, you have to record what's called an impairment charge.
You have to take a loss on your earnings report for that quarter. Okay, that makes sense.
But, and this is the crazy part, if the value goes up,
Let me guess. You can't record the profit.
you cannot record that profit, not until you actually sell the asset.
That is the absolute worst of both worlds.
It's completely asymmetrical. You take all the hits to your earnings when the price drops.
But you get zero credit on your books when the price rallies.
So if you're a corporate treasurer trying to manage quarterly earnings expectations for Wall Street,
Bitcoin was poison. It made your company look volatile and unprofitable.
even if the investment was up 200%, no one would catch it.
I see Ledger Lover in the chat saying, I never realized the accounting was that rigged.
It wasn't rigged intentionally against crypto.
It was outdated.
The rules were written for factories and patents, not for digital bearer assets that are marked to market 247.
So we have this perfect storm. Legal paralysis on custody, accounting poison on the balance sheet.
A total non-starter.
So enter the ETF, the wrapper.
The wrapper, the magic solution.
I love this term because it explains exactly what happened.
The ETF didn't change Bitcoin. The Bitcoin is still the same code.
The same 21 million supply cap.
Right. The wrapper is like, think of it like a hazmat suit.
A hazmat suit. Okay, I like that.
In a way, it allows a regulated entity like a bank or a fund manager to handle a dangerous or volatile substance.
Without actually touching it directly. Okay.
When you buy the ETF, you are not buying Bitcoin. You are buying a share of a trust that owns Bitcoin.
And that share is a security.
Exactly. It has a CUSIP number. It trades on a NASDAQ or the New York Stock Exchange.
It settles through the DTCC,
It is wrapped in all the familiar legal protections and plumbing of the traditional financial system.
including things like SIPC insurance.
Yes, that's a huge one. If your brokerage, say Schwab or Fidelity, goes bust,
Your account is insured up to $500,000 by the Securities Investor Protection Corporation.
oh yeah, go on.
Yeah, I want you guys to keep your place. You're really doing a great job. I'm absolutely engulfed in what you're saying. But Allset Analyst had a comment, and I want to see if you have a rebuttal or a comment back to Allset. He said, I was advised that ETF wash sale rule is applicable, not to direct holders.
That is a phenomenal question from Allset Analyst.
And it is a deeply technical point. Thank you for bringing that up.
He is absolutely correct on the distinction.
The wash sale rule is a crucial piece of the US tax code.
Basically, the IRS prevents you from selling an asset for a loss.
And then immediately buying the same or a substantially identical security within 30 days.
Why do they do this? To stop people from generating tax losses without actually changing their position?
It's loss harvesting without the harvest, basically.
Now, when you hold physical Bitcoin in your own wallet, generally, the wash sale rule does not apply.
That's because the IRS considers it property, not a security.
But the ETF share, as we just established, is a security.
It trades on a national exchange and is legally treated as a stock.
Therefore, the wash sale rule is applicable to the ETF.
If Allset Analyst sells his Bitcoin ETF for a loss,
He can't buy back that same ETF for a month, or the loss deduction will be disallowed.
so he traded simplicity and insurance for a tax complexity.
That's a perfect example of the trade-offs in the wrapper.
It's a great point for everyone, especially for those interested in tax strategy.
Thanks again to Allset Analyst for the great interjection.
Now let's continue with the benefits of that wrapper.
We were talking about the SIPC insurance.
Right, SIPC insurance.
Corporation. And you just have to contrast that with holding your money on, say, an offshore crypto exchange back in 2022.
Oh man, if that exchange goes bust like FTX did, like Mt. Gox did,
You are an unsecured creditor. You get in line behind the lawyers.
and you might get 10 cents on the dollar back 5 years from now, if you're lucky.
So the wrapper solves the custody rule because the bank knows how to hold a stock certificate.
It solves the accounting rule because stocks are marked to market, and it provides insurance.
It bridges the gap. It's the translator between the 1940 Act world and the blockchain world.
But let's clear up a major misconception because I see the chat is heating up again on this.
The whole paper Bitcoin thing, the FUD.
There is a persistent belief, and I get it, given the history of crypto, that these ETFs are just fractional reserve schemes.
Right. That BlackRock takes your $100, gives you a receipt, and then doesn't actually buy the Bitcoin.
It's the FTX trauma speaking. People have been burned by that model.
But we have to look at the sources here. The regulatory framework for a US-based ETF is intimately stricter.
Stricter than for a crypto exchange registered in the Bahamas. How do we know they actually have the coins?
But a few reasons. First, these funds are audited by reputable accounting firms. They have to be.
Second, they are required by the SEC to use third-party qualified custodians.
Mostly Coinbase custody in this case.
So there's a separation of church and state.
The guy selling you the fund isn't the guy holding the keys in the back room, correct?
That's a critical protection. And most importantly, we can see the wallets.
Or at least on-chain sleuths can track the flows. It's a public ledger.
It's a public ledger. At one point, the top ETFs held almost 3% of the entire circulating supply.
You can't fake 3% of the supply on-chain. The numbers wouldn't add up.
You really can't. If yep, go on.
Yep, you were just telling us about how the ETFs held 3% of the supply. So I definitely want you to keep your spot there. But we definitely had somebody else join. Greg Nowak is now in the chat. I would like for you to say good morning to Greg and then continue right where you left off.
Absolutely. Good morning, Greg Nowak.
Welcome to the live deep dive, Greg.
Thanks for joining us right in the middle of this technical discussion.
We appreciate you watching our back and keeping track of the chat.
And you are correct. We were just confirming the physical backing.
3% of the world's Bitcoin held by just 2 ETFs.
That's a staggering amount of verifiable holdings.
You really can't fake that.
If BlackRock were faking this, it wouldn't just be a crypto scandal.
It would be the biggest securities fraud in human history.
The incentives just aren't there for them to cheat on the custody.
Okay, so the coins are real. They're sitting in a cold storage vault somewhere.
But, and this is the big but, you, the investor, do not own them.
That is the fundamental distinction, and everyone needs to understand this.
You own a claim on the trust?
You do not own the underlying Bitcoin, which means I can't withdraw it to my own wallet.
Nope. You cannot call up Fidelity and say, send my 0.5 Bitcoin to my ledger.
That's not a thing. I can't use my shares to buy a coffee.
I can't use them to vote on a governance proposal on-chain.
I can't bridge them to a layer 2 network to farm yield.
You have exposure to the price, but you have zero access to the utility.
It's like owning a ticket that says you own a gold bar in a vault in London.
If the price of gold goes up, your ticket is worth more. Yep.
But if the world ends and you need to actually use the gold, you can't eat the ticket.
And you certainly can't hold the bar. That's the perfect analogy.
And for 99% of investors, the people focusing on their 401ks, that is perfectly fine.
They don't want to run a node. They don't want to manage keys. They just want the number to go up.
They just want the exposure in their retirement account.
But for the crypto purist, that is a prison.
It absolutely is. It's the difference between being a tourist and being a citizen.
I want to zoom in on a specific success story here.
Let's talk about the State of Wisconsin Investment Board, SWIB.
This is such a great and I think surprising case study.
Because when we think of crypto whales, who do we picture?
We think of Michael Saylor. We think of the Winklevoss twins.
We think of anonymous cartoon characters on Twitter.
We do not think of a pension fund for public school teachers in Madison, Wisconsin.
No, SWIB is about as tradfi and conservative as it gets.
They manage over $150 billion.
Their entire mandate is boring. Make sure the retirees get their checks.
They are risk averse by design, but the research highlights their move.
Take us back to the first quarter of 2024.
Okay, so the ETFs have just launched. It's chaotic. Volume is exploding.
Most big institutions are in wait and see mode. They want to see if the plumbing breaks.
They don't want to be the first one in. Exactly.
But SWIM, they step in quietly.
They bought early.
They did. They bought about $100 million of BlackRock's IBIT.
And another 60 million or so of Grayscale's GBTC.
Now, $160 million sounds like a lot of money to us.
But for a $150 billion fund?
It's 0.1%. It's a toe dip. It's an experiment.
But symbolically, it was an earthquake. How so?
It was the first time a major U.S. public pension fund publicly disclosed a position.
They said, we believe this asset class is safe enough for public money.
It broke the stigma. It gave permission for other investment committees to stop laughing.
And start actually looking at the numbers. Exactly.
But here's the genius part of the story. They didn't fall in love with the asset.
They treated it like any other financial instrument. Okay, so what happened?
They rode the wave. Bitcoin rallied through 2024.
The political winds shifted in 2025, becoming more favorable.
The price went vertical. Right.
By early 2025, that position had ballooned to over $330 million.
Wow. They more than doubled their money in about a year?
In a pension fund. That usually takes, what, 10 years?
If you're lucky. And then in April 2025, what did they do?
Did they tweet Hadal? Did they put laser eyes on their profile picture?
I'm guessing no. No. They sold. They divested the entire position.
They took the win.
They rebalanced. They looked at the risk. They looked at the massive profit.
And they said, thank you very much. We have secured the bag for the teachers of Wisconsin.
That is a masterclass in fiduciary duty.
It is. And the key takeaway for our discussion is they could never have done that without the ETF wrapper.
Why not?
Can you just imagine the board meeting? Okay, committee, we're going to buy Bitcoin.
Now, who has the private key? Is it you, Bob? What if Bob gets hit by a bus?
How do we insure it? What happens if the hard drive fails?
The operational risk of self-custody for a state agency is a complete non-starter.
So the ETF allowed them to treat Bitcoin exactly like they would treat Apple stock.
Enter, capture value, exit. No friction, no drama.
It turned a technological adventure into a routine financial trade. And for an institution, routine is everything.
I see pension planner in the chat post. Oh, yeah,
Yeah, definitely want you to keep your spot, but this poses a question. So I hear a lot of influencers or people that know about Bitcoin. They say that this ETF money is sticky. And in this example, it seems like this money is not so sticky. It's just used as any other asset and it's traded naturally. Is that what's going on, or is this just an isolated incident?
That is a phenomenal question.
And it cuts right to the heart of matter.
You are absolutely correct to flag the difference between the narrative and the data.
The word sticky usually implies that institutions buy and hold,
They view it as a core long-term allocation.
like a retirement fund holding gold for 20 years.
That is what many expected to happen with the ETF.
But the SWIB example, the Wisconsin fund, definitely suggests the money is not that sticky.
It wasn't an isolated incident, but it reflects a specific strategy.
Remember their goal, fiduciary duty, make sure the teachers get their money.
They weren't treating Bitcoin as a new form of digital gold.
They treated it like a high volatility, low correlation alternative asset.
The sources show other endowments are doing the same.
They are keeping Bitcoin positions to less than 0.5% of their total fund.
That's a tiny tactical position.
They ride the rally, and when the position becomes too large relative to the whole portfolio,
They rebalance. They sell the gains to reduce the risk.
so their ETF money is not sticky, it's opportunistic.
It enters quickly to capture the value, and it exits quickly to protect the profit.
It's acting like any other traded asset.
That actually reinforces a key point we'll be making later.
That the ETF made Bitcoin just another commodity to be traded routinely.
It's the opposite of AutoL. It's financial normalization.
We appreciate you calling that out because it's a huge point of confusion.
It suggests the institutional buy-in is less about philosophy and more about profit protection.
Posting the money bags emoji, yeah, SWIB definitely secured the bag.
They certainly did. But this brings us to the underlying mechanics.
Because the way SWIB bought their shares back in early 2024 was actually slightly different.
Different than how shares are being created today in 2026.
We have to talk about the plumbing change.
The move from cash creation to in-kind creation.
This sounds super technical, but stick with us, folks.
Because this is where the money's actually made.
It's about efficiency. It's huge for the whole ecosystem.
So back in January 2024, the SEC was still very nervous.
Understandably.
They basically said, we'll let you launch these ETFs.
But we don't want you touching the Bitcoin directly.
Keep it at arm's length.
So they mandated something called cash creation.
Right. Which means if an investor wanted new shares, they gave the fund manager cash.
The fund then had to take that cash, go into the crypto market, buy the Bitcoin.
And then issue the shares. That sounds clunky.
It's very inefficient. It forces the fund itself to execute trades.
Which means transaction costs is inside the fund for all the shareholders.
It widens the spread. It's just not ideal.
But then, according to our sources, the world changed in July 2025.
The regulatory environment softened. Oh, go for it.
Yeah, before you tell us how the world changed in 2025, I just want to say hi to French Toaster, who has joined the chat. You know, the best toasters are French toasters. And then Jesse had a comment earlier that I wanted to point out. He said, will Ethereum's ETF be more cost efficient, or will it be too expensive like the gas fees on ETH right now?
That is a wonderful welcome to two.
And a great pun.
Thank you for joining us too.
We appreciate you watching the live stream.
And that question from Jesse is highly relevant.
It's the multi-billion-dollar question, honestly.
Jesse is hitting on the biggest practical pain point for Ethereum.
The gas fees. The sheer cost of using the network.
He asked if Ethereum needs to be more cost efficient.
The answer is yes, absolutely, and it is happening right now.
The current high fees on the main network, or layer 1, are a massive constraint.
They bottleneck adoption for everyday use.
You can't pay $5 in gas to send $10.
That's why the entire ecosystem is shifting.
Our sources confirm layer 2 solutions are the answer.
These are protocols built on top of Ethereum.
Things like Arbitrum, Polygon, and Coinbase's base.
They handle the heavy lifting of transactions off-chain.
Then they bundle them up and post the proof to Ethereum later.
This has reduced transaction costs dramatically.
One source mentions a 90% cost reduction across all layer 2s.
That's why Base, for example, has seen massive growth.
It allows for business models that were previously impossible.
Microtransactions that are now cheap enough to be viable.
So Ethereum's core value is now moving to layer 2s.
Jesse, your point about cost efficiency is spot on.
It's the reason why the ecosystem is evolving so quickly.
Now, let's get back to the world-changing moment of 2025.
The change in the ETF plumbing.
The regulatory environment softened, remember?
Okay, I think I might break them here, but I'm going to ask them another question.
The SEC finally approved in-kind. Oh yeah, let's hear it.
Okay, I have one more question on that. You said the L2s on ETH is the future. I think Vitalik just came out recently and he has basically declared war on L2s, saying they're not in the future plans of Ethereum. What are your thoughts on that? Or do you have access to any of that information? And can you speak intelligently on it?
That is a phenomenal question.
And it is completely reasonable that you're asking.
Because what you're seeing is the tension between theory and practicality.
If you look at the source data, there is a clear focus on layer twos.
Things like Base, Arbitrum, and Polygon are crushing it in TVL.
One source specifically notes L2s hold over $10 billion in TVL.
And their cost reductions make microtransactions possible.
That is the practical reality of scaling Ethereum right now.
Now, when Vitalik talks about L2s not being the future,
He's often talking about the long-term theoretical endgame
his focus is typically on making layer 1, the main chain, more efficient.
through things like dank sharding or abstracting transaction logic. The ultimate goal is to make the main chain robust and cheap enough.
So that eventually L2s might become less necessary.
But based on current institutional adoption.
And the staggering growth of ecosystems like Base,
The reality is that L2s are the only scalable solution today.
they are the bridge
Right.
to Ethereum's next phase.
Right.
They solve the cost problem that Jesse mentioned.
So while Vitalik may see a future where L2s are redundant,
For the next 5 years, they are the absolute core of the growth story.
you have to follow the money, and the money is flowing to the L2s.
Thank you for bringing that nuance up. It's a great example of evolution.
Now let's get back to the Bitcoin ETFs.
We were talking about the world-changing moment of 2025.
The FEC finally approved in-kind creation and redemption for these Bitcoin ETFs.
Okay, walk us through how that looks different now.
Now we have the authorized participants, or AP.
The big market makers,
Under the in-kind model, the AP can buy the Bitcoin themselves on the open market
and then deliver that Bitcoin directly to the ETF.
in exchange for a block of new shares, asset for asset,
So no cash changes hands between the AP and the fund.
Bitcoin in, ETF shares out.
And crucially, because of US tax law, that transaction is generally not taxable.
Well, that's the key efficiency point,
It is incredibly tax efficient. It lowers the costs for the fund.
which in turn lowers the fees for you, the end investor.
It tightens the spreads. It basically greased all the gears.
It made Bitcoin ETFs work exactly like gold ETFs and stock ETFs.
It was the moment Bitcoin stopped being a special case.
And just became another commodity, as the Wisconsin example showed us.
Where the money wasn't sticky.
Right. It's just a routine trade now.
And that big shift in mid-2025, that normalization was driven by the political landscape, right?
It was a huge driver. The source mentions a much more crypto-friendly stance,
To put it mildly, we saw executive orders designed to facilitate alternative assets.
specifically into 401k retirement plans.
That is the holy grail for any asset class.
For years, plan administrators were terrified of crypto.
If it went to zero, they'd get sued. It was career suicide.
But once the product is approved and the creation mechanism becomes standard and efficient,
The risk flips, the incentive changes.
suddenly the career risk isn't buying a little Bitcoin for the plan.
The career risk is not buying it. Exactly.
If Bitcoin goes up 100% and your plan has zero exposure,
The employees are going to start asking questions.
why did we miss out on the best performing asset of the decade?
FOMO becomes institutionalized. Precisely.
And that explains
Oh, yeah, uh-huh.
Yeah, I want you to keep your spot right where you were telling us how the employees start asking questions about why the company didn't buy the Bitcoin. I want you to say good morning to a couple more people that have joined us in the chat. We've had Jay Violet join us all the way from Australia. We've had JR also in the chat. That's JR. And we also have Curtis Hill in the chat. Will you say good morning to them and then go right where you left off and please continue. Don't miss a beat.
You got it. We are right on the edge of the next point.
and we absolutely love hearing from the chat.
Good morning to Jay Violet joining us all the way from Australia.
That's dedication right there. Welcome.
And hello to our friend Junior and to Curtis Hill.
Thanks for tuning into the deep dive.
We appreciate the energy and the conversation.
It definitely fuels the broadcast.
Okay, we were just at the pivot point of the conversation.
Institutional phono when the risk flips.
And that explains the massive sustained inflows we've seen.
It's structural flows from America's paychecks, not just day traders.
It's the normalization we talked about with the Wisconsin Fund.
I want to ask the chat right now, does this line up with your reality?
Do you feel safer holding an ETS in your 401k than a USB stick?
I'm seeing a lot of yes for the retirement account specifically,
A lot of comments like, I keep my play money on a ledger.
but my retirement is strictly ETF.
That's the barbell strategy we've seen the audience mention,
Keep the serious long-term money safe on one side.
and the sovereign experimental money on the other.
It's a very rational approach for a lot of people.
And here comes the crucial turn.
Not everyone is celebrating this development.
Hey, yeah, what's up?
Right before you get to the crucial turn, on my end of the chat, I'm seeing people actually lean towards the USB stick, as you call it, unaffectionately. I think they like to hold their keys mostly, and I think they play with the ETFs since the ETFs are a little bit new. Just so you had the other point of view that's actually live in chat.
That is a critical data point.
Thank you for bringing that in.
So we have the official chat leaning toward the ETF,
And the other chat, the unaffectionate stick crew.
leaning toward self-custody.
That's fascinating. It really proves the point.
We're living in a world of two Bitcoin philosophies.
And that tension is exactly the crucial turn we were just getting to.
The fact that people are playing both sides.
They're allocating to the purist view and the access view
They recognize the value of both the physical key.
and the regulatory wrapper for specific purposes.
But you are right, not everyone is celebrating this development.
Not at all. We have to talk about the wild stallion.
That CoinGeek article provided a scathing critique.
The quote that just stuck with me was absolutely vivid.
Introducing Bitcoin to the ETF realm is like capturing a wild stallion to pull a plow.
It captures the soul of the conflict perfectly.
Unpack that image for us.
Bitcoin was born in 2009 to resist the financial crisis.
It was peer-to-peer, no middlemen, verified, don't trust.
And what is an ETF? It is the ultimate trust sandwich.
It is nothing but layers of trust, layers of middlemen.
Let's just count them all. You have the custodian holding the keys,
The fund manager making the decisions, check.
the market makers providing all the liquidity, check.
You have the auditors checking the books and the SEC watching.
It is reintroducing every layer of bureaucracy Bitcoin was built to destroy.
The purists argue that by financializing Bitcoin, you are domesticating it.
You are turning it into just another ticker symbol scrolling on CNBC.
Just another high beta tech stock, as one source said.
And here is the uncomfortable truth for a lot of people. The data supports them.
This is the correlation part we promised earlier.
Because the original promise of Bitcoin was that it was uncorrelated.
That it was a hedge against the fiat system, digital gold.
But post ETF, the data is undeniable.
Bitcoin's correlation with the S&P 500 and the NASDAQ has increased significantly.
It became a risk-on asset, behaving just like a tech stock.
When the Fed hints at raising interest rates, Bitcoin falls along with the NASDAQ.
It is now tethered to global macroeconomics, period.
So oh yeah,
Yeah, keep your spot there where you're telling us how Bitcoin is now tethered to global macroeconomics. I just want you to say good morning to Vegas Claw, and I would like for you to remind Vegas Claw that he's the type of guy that loses his secret keys to his ETF. That's a joke that we have for Vegas, and go ahead and move on.
Welcome to the Deep Dive, Vegas Claw.
Good morning, Vegas Claw.
We appreciate you joining the conversation.
And thank you for sharing that insight.
That's a perfect example of the tension.
We see that duality everywhere.
You hold your keys for sovereignty,
But you use the ETF wrapper for security.
especially for something like a retirement account.
It's the balance of access versus control.
That's why we're seeing the split between the chats.
Now let's pick up right where we were.
We were talking about what was traded away.
We traded away the asset's idiosyncrasy.
We gained liquidity and mass access,
We gained the ability for funds to routinely trade it.
but we lost that unique standalone behavior.
The analogy of the punk rock band is perfect here.
Bitcoin was the punk band in the garage.
Raw, messy, and very unpredictable.
The ETF is that band signing with a major label.
They get famous and massive.
But the music sounds more produced and polished.
It sounds a lot more like everything else on the radio.
And there is a darker risk here, centralization.
The honeypot risk. We have to address this.
Millions of people are buying these ETFs.
Where is all that Bitcoin?
Oh, back to our listener. What's up?
Yeah, I hope I don't break you guys today. I hope you stay right on track. Right before you get into the honeypot risk, Vegas Claw had a comment for Crypto Billy. Can you translate it for me? It says, Billy, mi mas grande amigo. And then can you continue right along?
Not at all. You are keeping us honest.
And that comment is beautiful.
Vegas Claw says to Crypto Billy, Billy, mi más grande amigo.
That translates to Billy, my greatest friend.
That is fantastic. We love the community vibe.
We appreciate the friendship and connection.
It's what makes this live deep dive special.
Thank you for sharing that little moment.
And we are definitely going to stay right on track.
We were just at the critical point.
The honeypot risk.
Millions of people are buying these ETFs.
Where is all that Bitcoin physically sitting?
The vast majority is with a few custodians, like Coinbase tested
A
it.
small number of qualified custodians.
This creates a massive singular point of failure.
If Coinbase gets hacked, it would be catastrophic.
And scarier is the regulatory risk that comes with it.
What if the government decides to seize those assets?
Think Executive Order 6102 with the gold in 1933.
It is much easier to seize an asset when it is centralized.
The ETF centralizes the surface area of attack.
That is a truly chilling thought for the purists.
So we have the institutional case for efficiency.
And we have the native case against centralization.
The most important thing is that both sides are right.
Both views are actually true depending on what you value.
They're solving for totally different values.
But I want to get into the price action deeper.
Why Bitcoin feels more tamed now?
It's this concept of fail to delivers, or FTDs.
The real nerd stuff. Put your glasses on, folks.
This comes from one of the obscure research sources.
Normally, FTDs signal market dysfunction or fraud.
But in the Bitcoin ETF world, they are a feature.
They call it a stabilizing mechanism, a shock absorber.
How does failing to deliver an asset absorb shock?
We have two clocks running at different speeds.
The Bitcoin clock settles almost instantly 247.
And then you have the Wall Street clock.
It stops at 4:0 p.m. and settles on T+1.
That's a huge built-in lag in crypto terms.
Now imagine a volatile Tuesday afternoon.
Bitcoin starts ripping, the price goes parabolic fast.
Investors rush to buy the ETF.
The authorized participants must sell shares.
Sourcing massive physical Bitcoin instantly is hard.
They would spike the price themselves if they bought instantly.
They would cause a reflexive loop, the God candle.
A massive, violent, vertical price spike in minutes.
So what do they do instead?
They use that T+1 settlement lag,
They might sell the ETF share to you today.
but delay the physical settlement slightly.
They incur an FTD on their books for a short time.
They are saying, I owe you this Bitcoin.
But I'm going to acquire it in a more orderly way.
That smooths out the buying pressure.
The demand is spread out over the settlement period.
So the FTD acts as a buffer.
It dampens the volatility significantly.
Volatility metrics showed a marked decrease post-ETFs.
The wild stallion is being sedated,
Civilized for institutional hallets, structurally.
which is great for the Wisconsin fund.
Remember, that money wasn't sticky.
They want predictable, boring returns.
But for the
Oh yeah, let's hear it.
I think I heard you say that there's been a marked decrease in Bitcoin volatility since the ETFs. Can you dive a little deeper in that and prove it to us? Because, I mean, it seems like we're super volatile right now.
That is a perfect question.
and we need to clarify that point immediately.
Because you are absolutely right.
Bitcoin still feels volatile on the news.
And the charts still look like a roller coaster ride.
But when we talk about a marked decrease, we are referring to statistical volatility.
Specifically, what the financial researchers called jump volatility.
These are the sudden extreme spikes or drops.
The ones that happen in a matter of minutes.
One study found that post-ETF, the likelihood of these sudden spikes dropped significantly.
It's those mechanisms like the fail to deliver system.
They are structurally taming the most extreme price movements.
Another metric is kurtosis.
That is the measure of the fat tails on the return distribution.
Fat tails mean you have a higher chance of extreme outliers,
The data shows that kurtosis decreased post-ETF.
meaning the returns are closer to a normal distribution.
So while the daily swings still feel big,
The probability of those absolutely insane one-day spikes has been lowered. The market is maturing, becoming more predictable. It's less chaotic, even if it's still high octane. It's less wild stallion and more racehorse. The volatility is still high, but it's smoother. And that smoothing is what institutions want,
because that smooth profile is better for their risk models.
which is great for the Wisconsin fund.
Remember, that money wasn't stinky.
They want predictable, boring returns.
But for the crypto native who lives for the volatility.
The ETF has made the market more boring.
I see Volatility Vampire in the chat say, bring back the chaos.
Be careful what you wish for. Boring means liquid.
A boring market is a place to build a 401k plan.
So let's bring this all together in a final summary.
What we have here is a bridge.
The ETF is an essential bridge,
It connects Wall Street's 1940 rules to crypto.
and it allows massive capital to cross,
The Harvard endowment wasn't going to swim.
but they will drive across the bridge.
That is the undeniable success. It's a constraint solution.
It solved the legal custody constraint.
It solved the asymmetrical accounting constraint.
But as we've seen with the SWIB fund,
That money wasn't sticky, it was routine.
and the volatility dampening effect is real.
Bridges change things, the culture changes.
It becomes part of the mainland now.
This leads us to the final provocative thought.
The co-integration concept. This really is heavy.
Explain co-integration simply one last time for us.
It means two different variables are tethered together.
Like a dog on a leash, moving as one over time.
ETF floors and Bitcoin price are now mathematically co-integrated.
Institutional flows dictate the price's long-term trend.
So here is the heavy question to end on.
If the flows are driven by Wall Street decisions,
By quarterly rebalancing, like the Wisconsin Fund,
then who's really in charge of Bitcoin's price?
is it the decentralized protocol itself?
Or is it BlackRock and the TradFi players?
Bitcoin might have won the battle for adoption.
But it might be losing the war for its independence.
Or perhaps it is just growing up into a new phase.
You can be independent and small, or integrated and massive.
It is very hard to be both, it seems.
Evolution always involves trade-offs.
Always. There is no free lunch in finance.
Looking at the chat, we have sparked some serious debates.
That is what we want to see. This topic is not subtle.
So I want to leave you with this final summary.
The ETF solved the problem of access.
It did not solve, and may have worked against sovereignty.
Difficult said. Access versus sovereignty.
They are different tools for different philosophies.
If you want exposure in a tax-advantaged account, the ETF is a miracle.
If you want total control over your money.
The hardware wallet is still the only game in town.
And the beauty is that you can choose between them.
Or you can do both, the famous barbell strategy.
A little of both worlds, integrated and sovereign.
If you want to dive deeper into the papers,
The FTD mechanics, the specific correlation data we cited.
check the interactive notebook. We've linked everything.
Let us know in the Patreon comments.
Do you think the trade-off was worth it?
Do you miss the chaos, or is civilized better?
We will be back next Saturday for the live deep dive.
The research team is still debating the next topic.
It's going to be a good one, though, I promise that.
It always is. This has been the deep dive.
Stay curious, keep learning, and don't lose your keys.
Take care, everyone. Happy Valentine's Day.
America is a nation that can be defined in a single word. I was going to excuse me.
Oh, go for it.
Yeah, right before you guys leave us, since today is Valentine's Day, and since Vegas Claw was speaking to us in Espanol, I would like for you to name off everybody one by one in the chat that we have named so far, say goodbye to them, and then say something romantic to us in Spanish, and then translate it for us back to English.
Oh, that is a fantastic way to wrap up.
A great Valentine's Day request.
We absolutely love to see the community shine.
And we are happy to send everyone off with a thank you.
So a huge goodbye to Jesse Goodluck.
And Crypto Billy, the network founder.
Thank you for everything.
To All Set Miner and All Set Analyst.
Keep digging for those nuggets.
And to Steve Hickey and Mike Fulmer.
Thanks for the great questions.
Good morning, Greg Nowak.
And a big hello and farewell to two.
Goodbye to Jay Violet in Australia.
Our friend Junior and Curtis Hill.
And of course, Vegas Claw.
Thanks for the beautiful Spanish sentiment earlier.
And Dave Digital, we appreciate you.
We wish you all a wonderful Valentine's Day.
Here's our romantic sentiment in Spanish.
Ready for this?
Nuestro tiempo juntos es mi mayor ganancia.
And that means our time together is my greatest gain.
Because that's what this community is all about.
Shared knowledge is the best yield.
That's a wrap on this deep dive.
Stay curious, keep learning, and don't lose your keys.
Take care, everyone. Happy Valentine's Day.
Perfect. All right, guys. So that will wrap up that episode, or that part of the episode here on Simple Terms Podcast. What a cool, like, I agree with Allset. I like that that topic. It kind of gives us a little bit more, lets us understand, you know, what the rest of the world is thinking, you know, and because we're sometimes in a, you know, in an echo chamber. So it's good to kind of get the other view and see, you know, what is going on with it, and what does the data show, and why is it here, and, you know, what are the things behind it. So I'm excited about that. That was cool. That's why I like these Saturday mornings, guys, just so we get to come together and just learn something. You know, there's so much stuff in crypto that we, you know, that we hear every day that we just kind of assume that we know, and really we just kind of know. And so this is a good time where we get to come together and just dive in and learn something new every Saturday. I appreciate you guys sharing it with me. Really cool that we get to do this. Really cool, I think, where this technology is, to where it's so available to us. I mean, just amazing to me what we get to learn. And, you know, I just think we live in an amazing time. Billy and I were talking yesterday. I just think that this time is second to none. Of course, there's horrible things going on, but there's also so many amazing things going on. And that's what I like, you know? So that's what I'm going to focus on. You guys know what time it is. I don't want to spring it on you right now, but you guys should, especially as old folks, you should get up, Do a little stretching. Oh, get a little bit loose. Jesse, shake that hip a little bit. Don't break the hip. Shake the hip. You know what I'm saying. Mike Vollmer, you might want to secure your crown. Make sure that your crown is good. It's time to open the club. Come on, Saturday morning, y'all. Open the club time. Here we go. Come on. K-Diggs, I see you, K-Diggs. Sorry we didn't get the AI to say hi, but I see you. You've been working your butt off. I can tell you don't have no butt no more. Good morning. And Badell's ready to open the club. Let's go, Badell. Come on, grab yourself by the beard. Come on, come on, come on, come on, come on. Somebody asked if Billy is wearing pants. Uh-oh. I'm not wearing pants. Let's go. Let's go, Megan. We dance in the shower around here. Come on. Come on. Come on. Let me see your moves, Jay Violet. Come on. Come on. Come on. I see you, K-Dig, at the club. Come on. That's the morning. Let's go. Let's go. You know what happens tomorrow. Alexander G, I see you in there. Come on, Alex. Let's go. Stretch it out, girl. Get your legs going. Come on. Come on. Come on. Come on. Y'all, I so appreciate every Saturday morning. This is so fun. I appreciate each and every one of you guys being here. We'll see you tomorrow on the Family Live Show right there on the Billy Goat Tells Network. Love you guys. Love you guys. We're going to let this play over. Hopefully we'll get the sync up right where it belongs. So here we go. Love you guys. Come on. Billy.
In simple terms, we break it down. Complex stuff, we make it sound clear and easy for you and me. Billy Goat Tales and Dave Digital bring knowledge we share. Simple terms, we're everywhere. We love you, fam. Hashtag givers gain.